Okay, hello and welcome to another tutorial video. As you can see, we're going to cover the cash flow statement here. And really, this video is going to complete our introductory series on the financial statements. As usual, the goal is not to tell you about the statements from the perspective of an accountant or a bookkeeper, but rather from someone who is valuing companies and completing some type of financial model. So if you want this tutorial in writing and all the screenshots, the PDFs, the Excel samples, you can go to this URL. Just go to our knowledge base page, accounting, and then cash flow statement. I will also pin this URL in the comments as the first comment, so you can click it right there, and it will be in the video description as well. I'll start with the short answer and then go into the longer, more detailed answer here. So to understand the cash flow statement, you really have to understand the income statement first, which shows a company's revenue, expenses, and taxes over a period, and items appear on the income statement based on delivery or allocation to that period. They also need to affect the business income to the owners of the company. The cash flow statement exists because not everything on the income statement is earned or paid in cash in the period shown there. Also, many items that do affect the company's cash balance are not actually shown on the income statement because they do not represent delivery or allocation in the period shown on the income statement. So for example, if a company records $100 in revenue from a customer because it has billed the customer and then delivered the product or service, but the customer hasn't yet paid that in cash, that $100 in revenue shows up on the income statement, but the problem is that the company hasn't actually received it in cash yet. So on the cash flow statement, there will be an adjustment for a $100 reduction in cash flow because the company doesn't actually have that cash yet. The cash flow statement has three main sections, and we're going to go through each of them sequentially here. Typically, the cash flow statement starts with cash flow from operations, which usually has net income at the top and then makes some non-cash adjustments. So these are adjustments for things that were listed on the income statement, but which are actually non-cash or which have a cash component that is different from the income statement number. And then there will be a section for the changes in operating assets and liabilities, also known as the change in working capital. You can think of this section as corresponding mostly to the current liabilities and current assets of the company. So if we just look at the current assets and exclude cash, and then we look at the current liabilities and exclude debt, that is roughly speaking what this section corresponds to, though there are, of course, exceptions. Moving down, there's cash flow from investing, which includes items that are related to financial investments, acquisitions, and plants, property, and equipment. And roughly speaking, this corresponds to the company's long-term assets. So if we go to our Excel version here, you can see that we have purchases and sales of financial investments, capital expenditures, we have a line about lease assets, and then we have PP&E sale proceeds and acquisitions. And for the most part, these items all match other items that are within long-term assets on the balance sheet. Moving down, once again, there's cash flow from financing, which includes items relating to debt, dividends, and stock, such as stock issuances and repayments for the debt and stock repurchases, for example. This roughly corresponds to long-term liabilities and equity. So looking at our example right here, we can see that there are line items for issuing and repaying debt, some lease-related items, preferred stock, issuing common dividends, issuing and repurchasing common shares. And for the most part, these items correspond to the lines within long-term liabilities and equity, such as debt and the lease liabilities and the dividends and the stock repurchases and issuances for the common shareholders' equity, for example. Leases confusingly could show up in all of these sections, or at least multiple sections here, and you should really look at our separate lease accounting tutorial for more on this one. In real life, we tend to consolidate and simplify the cash flow statement to make it easier to project and link, but in some cases we will actually add line items such as dividends or debt issuances and repayments, even if the company doesn't have them right now. Maybe we want to support it in the model, or we want to make some changes to the company going forward, and so we might add these line items in that case. If we look at Monster Beverages' cash flow statement here, if you look at what they have in their filings versus the version that we have here, our version is slightly simplified. For example, we've taken some of their smaller line items and put them into an other items category right here. So in that sense, it's simpler because we're not showing gains and losses separately, and we've taken some of these other smaller items and just combined them. But we've also made it a little bit more complicated because, for example, in their cash flow from financing, they have lines for borrowing debt and repaying debt and issuing stock, but they don't actually have anything for dividends. So we've actually added a line item here. And so we can modify the cash flow statement in different ways. We often tend to simplify and consolidate lines, but it is possible to add line items here as well. That's the short version. Let's go into the longer and more detailed version now and go into some more advanced nuances. So I'm going to start with some differences between US GAAP and IFRS. Again, we have a full tutorial on this, but I'm just going to summarize some of the key points on the cash flow statement here. Then I'm going to talk about when an item appears on the cash flow statement versus when it doesn't appear. We'll talk about forecasting the cash flow statement in financial models, and then we'll go into the cash flow statement in interviews. I'm going to wrap up here with a quick discussion of whether the cash flow statement is actually the most important financial statement, or at least is more important than the income statement, for example. IFRS-based companies often start the cash flow statement with operating income or pre-tax income instead of net income, or in some cases they may use the direct method to show cash inflows and outflows, which means that you don't see any of these adjustments or adjusting entries, you just see cash inflows and cash outflows from all their business activities. If you take a look at EasyJet in the UK, I'm going to pull up their interim report right now, I think you can look at their cash flow statement and see some of the problems. Dividends paid should not be in cash flow from operations. Cash generated from operations doesn't really mean anything. We need this to start with operating income or net income or something like that and then show the adjustments. And there are many other weird things here, such as how they show the change in cash or some of the change in cash within cash flow from investing activities. So typically, you need to make some adjustments. And if we go to note 13 right here in their financial statements, let's just go down and take a look at this. You can see here that they do provide a reconciliation. So what we would do here is start with this reconciliation. We probably still change this to start with net income rather than operating income, but they do actually have their adjustments for non-cash items and the change in working capital right below this. So for a company like this, we would have to adjust their cash flow statement with this type of reconciliation. And I just have a summary of the changes here. Long story short, it can be fairly complicated. And normally with IFRS-based companies, you want to find their own internal reconciliation before you do a lot of extra work just to make the format suitable for financial modeling. Let's talk about the second point. When does an item appear on the cash flow statement? So to appear in the cash flow statement, an item has to be an adjustment to something that was non-cash on the income statement or something that affects the company's cash balance but was just not shown at all on the income statement. So I think the perfect example here is capital expenditures or CapEx and depreciation. Let's go back to our interview style model here so I can show you. Now on the income statement, capital expenditures does not show up because it corresponds to items like factories and properties and equipment that are going to be good for many years. It is a cash outflow though, so we need to show it on the cash flow statement, which is why it's on the cash flow statement. But then if you look at the corresponding item, depreciation, you might wonder why this appears on both the income statement and the cash flow statement, because it represents an allocation of that capital expenditure spending over a period of time. It's on the income statement because it represents an allocation to this period. So we bought this factory or equipment previously, and it is still useful in this period, so it's allocated to these years, but it's also non-cash in those years. And so it is a add back on the cash flow statement, and that's why it appears on both the income statement and the cash flow statement. But those are the basic questions you have to ask. With interest and debt, it's quite similar. Interest is for the current period, it's allocated to the current period, the company pays it in the current period, so it's on the income statement. Debt issuances and repayments are not on the income statement because they affect more than just the current period. They affect what the company does going forward many years into the future, and they do affect the cash balance. So, of course, we need to show these line items on the cash flow statement, which is why they're within the cash flow from financing section. In terms of forecasting the cash flow statement in financial models, you could build separate schedules for CapEx and depreciation and deferred taxes and the debt. We have a whole tutorial on the debt schedule, for example. But if you have limited time, such as 30 minutes or 60 minutes or even 2 hours, you often just use simple percentages for many of these items. You can make items like D&A, CapEx, investments, stock-based comp, even the change in working capital, simple percentages of revenue, or even the change in revenue. You could make deferred taxes a simple percent of book taxes on the income statement. You can make dividends a percent of net income, for example. And then other items like stock issuances, acquisitions, asset sales, you tend to hold constant. If you take a look at the Monster Energy model here and how we're projecting some of these line items on the cash flow statement, a lot of them really are just simple percentages of revenue, CapEx and depreciation, even additions to intangibles and other things like that, stock-based compensation or percentages of revenue. Some are a little bit different, like deferred taxes, which is related to income taxes on the income statement. dividends are a percent of net income, and then other items here are held constant. One thing I do want to mention is that oftentimes with the change in debt, you have to do something a little bit more complicated here, because often this is based on the company's cash flow in the period and whether they are going to be above or below their minimum cash. If they're below the minimum cash, you have to assume an additional debt issuance. If they're above the minimum cash, then you might assume some debt repayment there. So this is the one that can be a little bit more complicated, even in fairly simple models. But for the most part, you can always simplify the others down and make them simple percentages of income statement line items. And then finally, the cash flow statement in interviews. When you get an accounting interview question, your walkthrough of the cash flow statement should always be in the middle part of your response, because you need the income statement's net income first before you can answer anything. So once again, let's go and take a look at our interview question model here. It is true that depending on your region of the world and the company and industry, the cash flow statement in real life may not always start with net income, but for models, for valuations, and for interview purposes, your cash flow statement should always start with net income. And to get this number, you need to trace through what happens on the income statement first. So if you get a question like this, a company records a $100 expense for a service that has been delivered, but it is not yet paid in cash. What happens? You would start by going through the income statement. Let's bring up our version of this model so I can show you. So we would model this as a $100 increase in accounts payable. And on the income statement, our expenses would be up by 100 and the pre-tax income would be down by 100. And so at a 25% tax rate, the net income here would be down by 75. Now, the next step of this would be the cash flow statement right in the middle. The net income is down by 75, but then this expense that we recorded was actually non-cash. So we add this back. We say that accounts payable goes up by 100, which is equivalent to saying that it was a non-cash expense for 100. And so at the bottom, our cash balance is actually up by 25. You then conclude this by going to the balance sheet, and you can see that the cash here increases by 25, and that's the only change on the asset side. And then on the other side, accounts payable is up by 100, and common shareholders' equity is actually down by 75 since it started at 1,300. So the liabilities and equity side is up by 25, the asset side is up by 25, and both sides remain in balance. So I have it written out down there, but you can see why it's important to go through the cash flow statement in the middle part of the process, because you need the net income as input, and then as output, you need the change in cash at the bottom. The intuition here is just that the company gets a $25 tax benefit from this expense because it gets the tax deduction before it actually has to pay the expense in cash, which happens in a later period. That's about it. So let's do a quick summary. US GAAP versus IFRS. If the IFRS company starts their cash flow statement with something other than net income, you need to find a reconciliation and probably change around the presentation of the cash flow statement. An item appears on the cash flow statement if it is a non-cash adjustment to something on the income statement, or if it affects cash, but it was not shown on the income statement because it doesn't correspond to a delivery or allocation in the period. To forecast the cash flow statement in financial models, you can make a lot of items like CapEx and depreciation simple percentages of revenue, or expenses, or taxes, depending on the item. You could make much more complex schedules as well, but for a simple model, it's not necessary. And then in interviews, you always want to walk through the cash flow statement in the middle because you always want to start with net income from the income statement. You always want to wrap up the cash flow statement with the change in cash at the bottom. And then on the balance sheet, in the final step, you want to walk through that change in cash as your starting point there. One final question I want to address here is this question of whether the cash flow statement is the most important statement, and specifically whether it is much better than the income statement for assessing companies. So cash flow is king in valuations, at least if you use a DCF to value companies, but I would point out that unlevered free cash flow in a DCF is actually based on both the income statement and the cash flow statement. In other words, if you just have a company's cash flow statement, you can't really calculate unlevered free cash flow or even use a DCF because you need what was on the income statement. You need to be able to adjust and remove the interest expense and adjust other items from there. The other issue is that the cash flow statement has many irregular and non-recurring items, so you can't just look at it and assume that the company's cash will always go up by 100 or 200 just because it has done so historically. You have to think about which items are actually going to recur in the future. And then finally, the cash flow statement doesn't show revenue, expenses, or unit sales directly. So although it tells you how the company's cash balance changes, it doesn't really tell you why the core business is changing. And so you usually need to go beyond this and look at the income statement, You always look at the balance sheet, and you always look at the notes to the financial statements because you want more details on things like the units sold and the cost per unit, for example, and those don't appear on any financial statement. You could certainly say the cash flow statement is the most important one, but you would never rely on it 100% in real life for all these reasons. You always want to look at the other statements to get the full context and get the full picture of what the company's business is worth. That's about it. Hopefully now you have a better idea of the cash flow statement and how it relates to the income statement and balance sheet and how to answer interview questions about it.